glad you can join me today. Because of doing this online, the regrades from the exam will be due no later than the 22nd, which is Wednesday. If you want to turn them in early, put them under my door and I will get them of my office, not of the classroom. Homework for 10:15 and 10:20 are also going to be turned in on Wednesday along with the 10:22 homework. I'm expecting perfection on the 15th and the 20th homework, as you've been watching YouTube videos on how to do the homework. Well, let's see what's important in Chapter 8. What you should be able to do. Discuss the relevance of inventory methods. Why do you value inventory? Compare and contrast periodic and perpetual inventory systems. Identify the effects of inventory errors on financial statements. Identify the items that you include as inventory costs. Compare FIFO, first in, first out, LIFO, last in, first out, average cost, methods of doing inventory, periodic and perpetual, and also some new methods, dollar value LIFO, and we'll talk about as well specific identification and pooling methods. We'll look at extracting inventory information from financial statements. Where do you find it? What do you use it for? And finally, converting cost of goods sold and ending inventory from LIFO to FIFO using the information disclosed in the financial statements and their footnotes. Inventory and cost of sales or cost of goods sold. There's many different types of inventory, from the tulips in the field and the underlying tulip bulbs to how do we value fish, from tiny fish to big fish. How do we value diamond rings and jet airplanes and automobiles. Generally for those we use specific identification because they're unique or extremely large ticketed items. How would we account for the inventory of spent fuel rods at a nuclear power plant? Jelly beans, probably we take a different tact at valuing inventory, and there we can use methods like FIFO, LIFO, and average cost because these are more commodities, they're more interchangeable goods. Some goods, some inventory we look at more closely than others. So for example, drugs in a pharmacy we account for and have very strict internal controls, whereas jelly beans and maybe asparagus, the internal controls aren't quite so tight. What do service businesses do? Do they have inventory? And finally, have you ever considered that mail to the post office is its inventory? So let's dig a little deeper. Different types of inventory. Retail firms have one kind of inventory. It's called merchandise inventory or just plain old inventory. It's where the store buys already finished goods, puts a price tag on them, puts them on the shelf, and offers them for resale. So that's merchandise inventory. Whereas manufacturing firms have not one but three types of inventory. Raw material, or sometimes called direct material or just plain old material inventory, is their inventory that they're going to use before it goes into production to make products. Work in process is the materials and its associated production components that are incurred during the production of the good. And finally, finished goods are those goods that have been completed and are ready for sale after completing the production process, but before they're sold to customers. All firms, including service businesses, have inventory, but we don't call it inventory unless we put a price tag on it and offer it for resale. Thus, firms such as service businesses call their inventory supplies inventory or office supplies inventory. If I look at a retail firm's inventory T account, we know that it has a beginning debit balance. It's increased when we buy pre-made goods, and it's reduced by cost of goods sold when it's sold to a customer, or if we return goods back to our suppliers or vendors. Remember, it's a current asset, so it will have an ending debit balance. Manufacturing firms are a little bit more involved because they have 3 different inventory accounts. Raw materials or direct materials account is a current asset, so it has a beginning debit balance. It's increased when we buy raw materials or materials. It's decreased when we use or those materials enter the production process, and then they transfer over into work in process. Beginning work in process is increased by the raw materials or the direct materials that enter the production process, as well as the cost of the direct labor and the overhead costs incurred in order to produce the good. Work in process is reduced once those goods are completed and ready for resale, and we call that the cost of the goods manufactured, or COGM, and the cost of the goods manufactured transfers out of the work in process account and into the finished goods account, signaling that it's ready for sale. So finished goods, another current asset account, is increased by the cost of the goods manufactured, and it's decreased when those goods are sold to customers, and so it's reduced by the cost of the goods sold. So I hope this has helped in the overview of a little bit about inventory.